If you're looking at your terminal right now and seeing red candles flooding your monitor with blood, if you feel panic tightening your throat because silver has dropped from $95.89 to $91, congratulations. You have become the perfect victim. You are looking exactly where the market makers ordered you to look. You are hypnotized by a paper illusion, while the largest heist of physical assets in the 21st century is taking place behind your back. Everything they tell you about market normalization is a lie designed to cover up a crime scene. What happened in the last 48 hours is not a correction. It is a technical glitch in the matrix. It is a moment when reality tore through the fabric of the financial simulation. While HFT, high-frequency trading algorithms, were dumping paper contracts in reaction to news headlines, real industrial giants, electronics manufacturers, defense contractors, and green energy companies didn't sell a single ounce. On the contrary, they were vacuuming the market. In this video, we will dissect the mechanics of the Great Disconnect. I will show you documents and numbers that prove the current price is a fiction. Exchanges are emptying, COMEX and LBMA warehouses are recording critical outflows. And while you count your losses on futures, insiders are preparing for an event that will make physical metal inaccessible to mere mortals. Welcome to the real world of scarcity. Chapter 1. The Anatomy of a Lie. Why the price falls when warehouses are empty. Let's start with what exactly the news is selling you. They tell you the market has calmed down. They tell you geopolitical tension has eased, so safe haven assets are no longer needed. Look at the chart, January 21st to 22, 2026. These dates will go into textbooks as a textbook example of crowd manipulation. The scenario was played out perfectly. First, they drove you into euphoria. The price of silver, XAG USD, broke the all-time high, ATH, 95.89 per troy ounce. It was classic FOMO, fear of missing out, which forced the retail investor to jump into the last car of a departing train. And then, exactly 24 hours later, they pulled the rug out from under you. The price collapsed below 92 as you were, wiping out billions of dollars in capitalization in a matter of hours. The media explained it simply. Traders are taking profits. Rubbish. Look at table number 2 in your terminal. January 22nd, 0830 EST, release of US initial jobless claims data. Analyst forecast, 215,000. Actual value, 198,000. Do you understand what these numbers mean? It's not just good statistics. It is a death sentence for liquidity. The number of claims fell below the psychological mark of 200K. This means the US labor market isn't just strong, it is overheated. It is white hot. For the Federal Reserve, this is the attack signal. The economy can withstand high rates. There is no recession. This means they can keep rates higher for longer, indefinitely. As soon as this report hit the news agency servers, algorithms managing trillions of dollars instantly recalculated the math. The yield on 10-year US Treasuries, the benchmark risk-free rate, jumped to 4.26%. The dollar index, DXY, shot up, trading in the 98.50, 99.0 range. The robots saw these numbers and drew the only conclusion embedded in their code: sell metals, because silver is a zero-yield asset. When treasuries give you a guaranteed 4.26%, why hold volatile metal? It was this primitive linear logic of algorithms that crashed the price. But here's the anomaly they are hiding from you. While the paper price was flying into the abyss, something opposite was happening in the physical market. Look at the futures curve. We are observing a phenomenon that professional circles call the kiss of death for an exchange. This is backwardation. In a normal, healthy market, the price for delivery tomorrow should always be higher than the price today. Why? Because storing money costs money, insurance costs money. This is called contango. But today we see the reverse. Prices for immediate physical delivery are higher than prices for future delivery. Do you realize the scale of the catastrophe? This is the most reliable, most terrifying indicator of physical hunger. The market is screaming, "I don't give a damn about your futures in a month. I need metal now." Buyers are willing to pay giant premiums just to take a real bar out of the vault immediately, ignoring any costs. They don't believe the metal will even be available in a month. The spread between the spot price, screen price, and the real physical delivery price is widening by the minute. Major players, smart money, are taking metal off the exchanges. They fear an exchange default. They know that for every real bar in a COMEX vault, there are hundreds of paper claims. And when the music stops, there won't be enough chairs for everyone. This is not a correction. This is a flight from paper to physics. And the price drop you see is a smokescreen allowing insiders to buy up real assets at a discount while you panic sell your positions. Chapter 2. The Smoking Gun, the document no one read. But what triggered this mechanism? Where did this panic come from that first drove the price to the moon and then threw it into hell? The media fed you headlines about Trump and Greenland. Sounds like a farce, right? Another eccentric antic. But if you discard the political noise and look at the legal substance, you will see the hidden document that became the detonator. We are talking about the events of January 20 to 21, dubbed the Greenland Gambit. The White House issued an ultimatum to NATO allies, Denmark, Germany, France, and the UK. But the devil isn't in the territorial claims. The devil is in the economic ultimatum. The document lying on the table proposed introducing 10% tariffs on all imports from these countries with an immediate escalation to 25% by June. Do you understand what this means for global logistics? This isn't just a tax, this is a rupture of supply chains. Silver isn't just coins for collectors. It is the blood of modern industry. Without silver, solar panels don't work. Without silver, electronics are dead. Europe and the US are connected by a complex web of component supplies for green energy. Introducing a 25% barrier would mean instantaneous supply paralysis. It was this document, the threat of a tariff war, that made industrial giants panic. Solar panel manufacturers, consuming 15% of global silver, weren't looking at the RSI chart or Fibonacci levels. They were looking at the text of the ultimatum, and they understood one thing. Tomorrow, there might be no metal, so they started buying everything. It was this fear of an industrial vacuum that broke the 94 Odoros level and drove the price to all-time highs. And now watch the sleight of hand. January 21st, Davos, Switzerland. Trump takes the podium at the World Economic Forum. The market froze in anticipation of a declaration of war, but instead, the Davos Pivot happens. The president announces the abandonment of immediate tariffs. He talks about a framework of a future deal with NATO Secretary General Mark Rutte. He promises not to use military force. The crowd exhaled. Phew, no war. Algorithms tuned to analyze headlines flipped the switch. Risk-off mode changed to risk-on. Capital that was hiding in silver and gold flooded back into stocks. The S&P 500 and NASDAQ indices, which had been lying at the bottom, showed a vertical takeoff. The speculative risk premium evaporated instantly. Traders who loaded up on longs during the hype began taking profits, collapsing quotes with an avalanche of sales. This led to what you see now. The price crashed. But you are missing the main thing. The political threat disappeared. Tariffs were canceled, but the physical deficit went nowhere. Industrialists who started panic buying metal during the crisis did not return it to the market after Trump's speech. Think like a factory CEO. If you miraculously managed to buy a batch of silver before the threat of a trade blockade, would you sell it back just because Trump smiled in Davos? Of course not. You will put that metal in a warehouse and lock it with 3 deadbolts, because you saw how fragile peace is. You saw how a single document can stop your assembly line. Politicians called it off, but the mechanism of pumping out physical metal had already been launched. And now we are in a unique situation. The price has returned down, but the metal has left the market forever. This creates a supply vacuum, and this vacuum is about to start sucking the price up with a force that no Fed manipulation can stop. Right now, as you read these lines, something is happening in Shanghai and Mumbai that completely breaks the game of Western bankers. They are paying premiums you couldn't dream of. Arbitrage is underway there, washing the remaining bars from west to east. We are approaching the most interesting part, the mechanics of the trap the exchanges have driven themselves into. In the next part, I will explain why China introduced export controls and how the paper silver market ended up in a death loop from which there is no escape. While you look at the XAG USD chart in your terminal and see the number $91.80, you are seeing a lie. This is a price for tourists. This is the price of a paper napkin with the word silver scrawled on it. If you try to buy physical metal in Shanghai, you will face a completely different reality. Welcome to the zone of geographical arbitrage. Right now, a giant price gap has formed between the West, London, New York, and the East, Shanghai, Mumbai. The Shanghai Gold Exchange, SGE, commands high premiums over the international price. What does this mean in the language of logistics? It means metal is flowing like water from the low-pressure zone, where robots on COMEX artificially suppress the price, to the high-pressure zone, where China's real industry is ready to pay any price. Do you think this is an accident? No. This is a state strategy. Look at Beijing's actions. China has tightened export controls on strategic metals. Essentially, they have lowered an iron curtain on resource exports. Entry is a ruble. Exit is impossible. The market is fragmented. There is no global market anymore. There is the West trading receipts and the East accumulating real resources. This process creates a vacuum in the LBMA London vaults. Every time the price is dropped in the West, Asian traders say thank you and buy up physical volumes at a discount to resell them at home or pour them into production. This is not trading. This is siphoning. This is daylight robbery of Western vaults, legalized by exchange rules. And India is not falling behind. It's wedding season and an investment boom there. The population views silver as the poor man's gold. They don't look at the RSI. They look at the weight of the bracelet. For them, a price drop is a signal to attack jewelry stores. You sit in front of a monitor afraid of the drop. Meanwhile, billions of people in Asia are using this drop to take the last ounces away from you. Now let's dissect the mechanics of how you are being shaken out of the market. The media trumpets, investors are losing interest in silver, outflow of funds. Yes, the numbers don't lie. $686.41 million was withdrawn from the largest silver fund, iShares Silver Trust, SLV, in the last 48 hours. The mainstream interprets this as people are selling silver. I interpret this as smart money is fleeing the paper casino. You must understand the structure of an ETF. It is a paper derivative. When you buy a share of SLV, you do not own silver. You own a promise from the bank JP Morgan, the custodian, that the silver is lying there somewhere. When major players, smart money, see that there isn't enough physical metal, they perform a redemption. They take their money out of the paper fund, not because they don't need silver, but because they want to buy the real asset before the exchanges declare force majeure. This $686 million outflow isn't selling silver. It is a flight to quality. It is a lack of trust in the system. And here's where the trap snaps shut. Backwardation. Remember this term. The futures curve has inverted. Prices for delivery today have become higher than prices for delivery tomorrow. In the world of commodities, this is the equivalent of an air raid siren. It is the most reliable indicator of physical deficit. The market is screaming, there will be no metal tomorrow, give it to me now. Consumers are ready to overpay huge amounts for immediate delivery, ignoring storage and insurance costs. The spread between spot and physics is growing. Traders fear an exchange default. They realize that if all holders of paper contracts demand delivery simultaneously, the exchange will simply throw up its hands and say, we will settle you in cash. But the Samsung or Tesla factory doesn't need your fiat dollars. They need metal. You can't solder dollars into a circuit board. The timing is perfect. Right now, when the market is physically empty, deficit for the fourth year in a row, when COMEX and LBMA warehouses are recording outflows, market makers stage this exemplary execution of the price. Why? To trigger margin calls for weak hands. When the price falls from $96 to $91, leveraged traders are forced to close positions. The exchange sells their contracts. Who buys them? Those who know the real state of affairs. Those who see the empty warehouses. This is a classic squeeze. On one side, a drop in paper price knocking out speculators. On the other side, physical hunger forcing industry to vacuum up every available bar. The spring is compressed to the limit, and when it snaps, the price won't go to $100. It will teleport there, leaving all the paper bears with shredded deposits. Forget that you are an investor. For the next 5 minutes, become the CEO of a tech giant. Your task is to secure production for 5 years ahead. You look at the reports, solar energy, PV, already consumes over 15% of all global silver, and this figure is growing exponentially. Artificial intelligence, AI, next-gen data centers, chips, servers, all require silver for its unique conductivity. Defense, precision weapons, aerospace tech. In conditions of global instability, budgets here are unlimited. And now look at the supply. It doesn't exist. The market is in deficit. Demand in these sectors is price inelastic. This is the key concept. If silver costs $50, $100, or $200 per ounce, the iPhone manufacturer will buy it anyway. A phone contains a few cents or dollars worth of silver. Even a tenfold increase in the price of silver won't affect the final product cost, $1,000 and plus. The manufacturer won't say, oops, silver is expensive, let's make contacts out of wood. No, he will pay any price. This is exactly what is happening right now. While traders draw head and shoulders charts, industrialists are signing direct forward contracts with mines, bypassing the exchanges. The exchange ceases to be a place for price discovery. It is becoming a vestige. The real price is being formed in closed offices, and it is already much higher than $95. Mathematics will break this market. We consume X, we produce Y, XY. This deficit Z cannot be covered by printing paper futures. Sooner or later, physical reality will prevail over the paper illusion. And this moment will arrive when one major player publicly declares, the exchange failed to deliver the metal to me. This will be the moment of truth. In the next, final part, I will give you concrete numbers. Where will the price fly when the dam breaks? And exactly what do you need to do to not end up with cut paper instead of assets? Prepare to write down the levels. The window of opportunity is closing. We have reached the line. You already know why the exchanges are empty. You know how the paper squeeze mechanism works. Now, the main question, where will the price go when this dam breaks? Mainstream analysts are afraid to name the real numbers. They mumble about consolidation. But if you look at the private reports of investment banks, you will see panic disguised as forecasts. Look at the numbers they are whispering to their VIP clients while advising you to exercise caution. Goldman Sachs has already raised its gold forecast to $5,400 by the end of 2026. Do you hear that? 5,400. This isn't just growth. This is the devaluation of the dollar itself. Based on the historical correlation, gold-silver ratio, even this conservative scenario automatically catapults silver into the $100, $110 per ounce zone. This is a mathematical inevitability. Gold cannot cost $5,400 if silver costs $90. Arbitrage will tear this anomaly apart. Citigroup goes even further. Their analysts, seeing the real physical deficit, are setting a target of $100 by March 2026. They understand industry cannot wait for the end of the year. Factories need metal in the first quarter. And now listen to what they are saying in London. The LBMA analyst survey showed a consensus suggesting a doubling of the average silver price in 2026 compared to last year. Doubling. This isn't 10% per annum. This is a paradigm shift. This is a super cycle. But be careful. The final trap awaits you. Before the rocket leaves for the stratosphere, the architects of chaos will try to execute one last shakeout. A final rattling to knock the last ounces out of your hands. Technical analysis is screaming about the possibility of a bearish scenario. They might try to smash through the psychological defense at the $90 level. Their target is the $84, $85 zone. Why these specific numbers? That's where the 20-day and 50-day moving averages sit. That's where the stop losses of millions of traders are parked. If the price pecks at $84, the exchange crowd will panic and dump everything. And exactly there, at the $84 level, smart money has set out their buckets to collect your liquidity before the flight to 150 plus. Don't let them do this. The window is closing. Right now, as the price hovers around $91.80, you have a rare opportunity to act not like a speculator, but like a sovereign wealth fund. Remember, paper is risk. ETFs can be settled in cash, not metal. In a moment of crisis, your paper contract will turn to dust. Physics is freedom. Those who hold real metal dictate the rules. Volatility is noise. A 5% drop today doesn't matter if the fundamental deficit pushes the price to double tomorrow. The system is breaking. The paper crash is just a decoration hiding physical hunger. Don't be the ones who sold at the bottom of the correction. Be the ones who have resources when the numbers on the screen cease to matter. You have been warned. End of transmission.